Well, welcome everyone. Thank you all for being here today, both in person and everyone on Zoom. You can see we're doing a little bit of a different format today, which we're all really excited about up here. So it'll be better than, I don't know if it'll be better, but it'll definitely be different. Right. It'll be good. I think it's more conversational. Before we dive in, let me ask, is this the first time here for anybody? I know Chuck's first time, your first time. Wonderful. Your first time here. Well, welcome. Thank you guys so much for coming. I invite you to please come back. We have so much going on. At the front desk, there'll be one of our newsletters. Grab one and you can see the different classes we have going on. We have lunch in the cafe every day. That's really wonderful. So I definitely encourage you to come back and see all the fun stuff we've got going on here. So let me just give a little pre discussion here. So like most of our programs here, our programs are mostly free. They're open to the public. You do not have to be a member to come and take any of our classes. You can come and try a class anytime you like. And we're able to do that because generous people like you donate to us, as well as we have wonderful sponsors that sponsor our programs. And we have sponsors here today. Kerry Spence from Kerry Spence Estate Plans is one of our sponsors, as well as Perotti and Carrade. Kat and Mirka are here from them. They're one of our sponsors as well. So we're really excited to have them here. We cannot do this without everybody's support. We're such a community-driven organization, and we really appreciate that. So another one of our sponsors who's not here today is Valley Memorial Cemetery and Funeral Home. They're located in Nevada. There's some information on the back counter if you're interested in learning a little bit about them, but they're also one of our sponsors. I want to thank them as well. Today's presentation will be recorded. So if you signed up, we've got your email address. You'll get a recording of this presentation today, and you can share that with your friends as well. And you'll get it on email. I think I said that. If you're on Zoom, if you didn't sign up in advance, please make sure to put your email information in the chat so that we can get you if you want a copy of the recording today. To keep everything running smoothly, we're going to ask people here in the audience to write your questions down on the note cards. And when you're done, if you hold it up, Amy will come and get it and we'll ask your questions to kind of keep things going smoothly. We may hold them off till the end. We'll see how it goes. If you're on Zoom, please put your question, type your question in the chat, and Amy will transcribe it and make sure your questions get answered. So shall we get down to business? That's what we're all here for. So we all know, especially lately, that it's a very uncertain world out there. But we still know there's two things that are guaranteed in this world: death and taxes, right? So while we can't avoid them, we can plan and prepare for them and to help protect our loved ones, reduce their burden, and ensure that our wishes are honored. So today's presentation features 3 experts who can help us navigate this information. So we have Kerry Spence. She's the founder of Kerry Spence Estate Plans, and she has 48 years of experience helping individuals and families plan with clarity, care, and heart. And we also have Kat Harris and Mirka Singerman. Did I pronounce your names right? Yes. They're CPAs with a combined 45 years of experience. And they're with the full service firm of Perotti and Carrade that's in Larkspur. And again, both of these folks are our sponsors, so let's give them a big hand. Thank them for their support.
CPAs.
Oh, you moved to San Rafael. Well, welcome. Oh, Tara. Oh, okay. Why did I have it Larkspur? I apologize. It's still on the website, probably. No problem. All right. So why don't we get started by each introducing yourselves, a little bit about yourself, maybe why you decided to do this today. We'll start with you, Kerry.
Okay.
Hi. it on?
I think it's on. I'm so happy to be here. I'm Kerry Spence, and I'm a certified estate planner. I've spent over 4 decades helping families in Marin and Sonoma to think through what really matters when they plan. Estate planning isn't just about documents. It's about clarity, kindness, and leaving things in good order. For me, estate planning isn't just about documents and transferring assets. It's about transferring heart, values, and dignity. It's about helping families navigate some of the most emotional moments of their lives with clarity and compassion. I believe the future of estate planning belongs to those who can bring clarity, compassion, and wisdom together. That's the way forward. That's the work I do. Thank you.
Can you hear me? There, it's got a little delay. Hi, my name is Kat Harris. I'm one of the principals at Perotti and Carrade CPAs in San Rafael. I've been with the firm 20 years. We are a full service accounting firm. We do audit work for businesses, nonprofits. We do taxes, and that's what we're here to talk about today. And I think what we like to pride ourselves on is how we can communicate some of the more complicated matters in terms that we all can understand. We've got a wonderful team of accountants, support staff to help everybody in their tax needs and other needs. Born and raised here in Marin and love to be part of the community. So thank you for having us.
Hi, I'm Mirka Singerman. I am one of the principals at Perotti and Carrade as well. I've been with Perotti and Carrade for the last 12 years. And what I enjoy most about working there is that we do pride ourselves on client service. Like, we don't just do your taxes. We like to know who you are, connect with you, find out more about you, and that really helps to make the entire process much easier. I have lived in Marin for over 30 years now. I'm originally from former Czechoslovakia. That's my name, Mirka, from Slovakia. And I really enjoy living in Marin and connecting with people, getting to know them. I work mostly with individuals in my tax practice, and then also any estates and trust taxes. So looking forward to having this discussion with you.
Thank you. Thank you guys very much. Well, let's get started. I thought we could start off. Kerry, why don't we start with you? And can you tell us a little bit about what actually is estate planning? And I know this comes up all the time, probate, and what it is and why people want to avoid it.
Well, when you think about estate planning, that word estate is from the olden days when, you know, the rich had big estates and property, and they had to plan and figure out what to do with that. So that's what estate planning is a series of documents that that handle your assets and give you a voice if you're incapacitated. Why do you want to avoid probate? And what is probate? Probate is court intervention. If you die without documents and your estate is valued, if it's too big, it'll go through probate and it'll cost a lot of money. I had an example. So if you went to probate and you had a house worth $800,000, your probate fees would be around $40,000. So that's money that won't go to your beneficiaries. Plus, it takes a couple of years or more, and then everything is public record, so people can, you know, look at your case, and they can. There's names and addresses in there. There's dollar amounts of debts and dollar amounts of assets. So it's all public record. But if you plan properly, you can avoid probate. and all of that can be private.
And doesn't it also make the process easier for your heirs?
If you don't go through probate, yeah,
Don't have probate.
yeah, because probate takes a couple of years or more. So a properly executed estate plan will make things very easy for your executor trustee.
I was just going to add that estate planning is not just your assets, it's also your body and the wishes of your body. So if you become incapacitated or don't have the ability to do certain things, with usually part of your estate planning is addressing your physical needs and electing somebody to make your decisions on your behalf if you're not able to. So it's not necessary if you don't just have if you don't have assets, don't think, oh, I don't necessarily need an estate plan, because there's other possible needs. Or if you have young kids or children who depend on you and you want to make sure who's supposed to make the decisions for them. So there's not, it's more than just you have assets and who gets those assets after you pass away.
Correct. Well, this brings up a question that was a little further down in our conversation, but we might as well talk about it now. So I think, are you talking about like a financial power of attorney and the healthcare directive?
Yeah, I believe that stuff is all part of and correct me if I'm wrong, my understanding is like estate planning is kind of the entire umbrella. And within that umbrella are there's several documents that would be included, one of which is the trust, which is the financial. One is the power of attorney, which is the more medical, right?
So there's two types of powers of attorney, right? So there's the healthcare directive.
The healthcare directive.
Right.
Yeah.
And that document, someone handles your choices for you that you've pre-made if you can't do it yourself. The other power of attorney is a financial power of attorney. So if you have a trust, there are certain assets that don't go in a trust, like retirement accounts. And so you need this financial power of attorney to give your agent power to handle your assets left outside the trust, like a retirement account or perhaps a car.
And to pay your bills for if you're not able to and things like that.
Yeah. But if you don't have a trust, you definitely need the financial power of attorney because it's an incapacity planning document. If you're incapacitated, it gives someone the power to handle your finances for you.
Great. Thank you. So we talked a little bit just now about wills and trusts, and I hear these terms: living trust, irrevocable trust, revocable trust. Can you guys talk a little bit about like what each of those are and the differences, and like when do you need a trust? Does everyone need a trust? I think everyone needs a will for sure, right?
Yeah, that's right. So people, and this is funny because my father, who's from Wyoming, is an attorney, and he always says, honey, it's not revocable. It's I can't even say it. No, it's not irrevocable. It's not revocable. It's revocable or irrevocable. And I go, well, not in California, Dad. So irrevocable means you can't change it. It's locked in for life, and it's not something you want to do casually, and you need an attorney to do that. Revocable trust is what most people want, and you can revoke it or you can amend it, and a trust can last for a lifetime.
We asked about what a living trust. So like a living trust is what's the most common trust most people are looking for, and you would be getting with Kerry or an estate attorney. It is the ability for you to, and you can make changes basically kind of throughout your life, and it becomes irrevocable, or however your dad says it, upon your passing. So when you're living, you're allowed to make modifications to who's the trustee, who might be the beneficiaries. If you wanted to add a nonprofit to the list of donor or people who may get donations from you.
So the reason they call it living trust is because it lives beyond your death. It's an entity like a corporation. So it continues to live And so we call it a living trust, but we quickly fall into just calling it a trust, as we're talking about the documents.
I wanted to add one more thing with the living trust, or the other one is that you do need to title your assets in the trust names. So even though like the living trust is you, really, it's your social and it's all your property. The property needs to be titled in the trust. Otherwise, it doesn't have the same protection. Sometimes people do get their living trust set up. What happened? Oh, I don't know. Zoom is talking to us. Yeah. So that's one big thing. Don't just go to an attorney and set up a living trust. Make sure you actually put the assets that you want to have in the living trust in the trust.
Yeah, you have to do that.
Very good question to ask someone that's going to do your living trust is if they will help you with the funding. Many times they won't. They'll just send a letter that talks about all these assets and you're supposed to figure it out yourself. So you want an estate planner that will help you do that process, because if you don't fund your trust, change title to your living trust, your documents are worthless.
What kind of things, what kind of assets go in the trust, the living trust?
Want to take that one?
The ones I can think of off the top of my head is usually any property, generally speaking, unless this is where you start getting creative if you start holding things in LLCs. But generally speaking, your property, brokerage accounts, bank accounts. Oh,
You have a question?
yeah.
Hold on with,
She was just saying
I know, but if you ask a question, let me give
They're
you
gonna
the
bring a mic.
microphone.
you asked a question.
No, hold. What is this?
Wants to hear you.
I have two accounts, one IRA and a broker,
No,
and both of them are with bank.
at the end.
It was,
Look at her.
I don't need to know.
Stop this.
I signed.
Look at this.
People can't hear you over here.
Stop.
We have somebody.
Oh, go ahead and say it and we can repeat it.
Okay, repeat.
Yeah.
I have two accounts,
Mhm.
an IRA and a brokerage account. Both of them are with Vanguard. If you know who Vanguard is.
Yes.
And I have filled out a form with Vanguard on both accounts and listed the name of people that get a percentage of my money in both accounts. So when I die, Vanguard takes care of it and gets the money to those people.
So with an IRA, generally speaking, you can list your trust as the beneficiary, or you can list individuals, and that would take care of that. You may be able to speak more on you can have on bank accounts, and there's paid on death. So it goes to somebody specifically, and then it doesn't have to. I'm just saying, in general, the assets that are usually going to be in your trust would be brokerage accounts, bank accounts, your property. Sometimes you can potentially circumvent all of it by having paid on death, but that wouldn't address, again, what if you become incapacitated, right? And somebody has to pay your bills. That wouldn't be addressed by what you have with Vanguard. So there are ways. Correct.
So, and that's those pay on death or transfer on death accounts do avoid probate. And that's why you need to talk to somebody that will help with the funding piece so that you can talk about, what's the best way? Do you want to put it in a trust, or do you want to use a transfer on death account? And so those are just important things to look at. But yes, for sure, those are set up to avoid probate.
And to just add to that, typically you don't want to put IRA in a trust.
Yeah.
No, IRA doesn't go there. IRA is its own that gets directed with a beneficiary. So that's not what we were including. Yeah.
And for making the trust a beneficiary of an IRA, especially under the inherited IRAs and that new thing, how does that work, or do we even want to address that right now?
Well, I don't think making the trust as a beneficiary would come up with that, more just the beneficiaries as individuals.
So we
having-
typically don't put the trust as a
Trust.
beneficiary.
No, yeah, it's people.
Yeah.
Okay.
Yeah, individuals.
There could be an exception to the rule there, but
Yeah.
generally speaking, you're going to want to usually just direct it to an individual. That person will inherit it. If they'd inherit after, I think 2020, some year that has passed, if they've inherited it 2025 and thereafter, they have 10 years to deplete the retirement account.
We want to talk any more about IRAs or inherited IRAs since
Yeah,
it came up?
We're here.
Inherited IRAs is interesting. I'd like to hear you guys talk about that a little bit and what the process is. Because a lot of my clients think when they name their children as beneficiaries to an IRA, they're just going to get the money, right?
Yeah,
And that isn't what happens.
they do have an option to get the money. It depends whether the person that has the IRA started to take the required minimum distributions. So that usually happens at 70 and a half. When if the person started to take the required minimum distributions, the person that inherited the IRA has to take the distributions and continue this process and has 10 years to deplete the account. If the individual did not start taking the distributions, then the person can choose to take the money out right away if they are in a low tax bracket, or they can push it out and spread it out over 10 years, or they can take it in year 10. So when we work with our clients, we often ask, did you inherit IRA during the year? Because then the follow-up question would be, who did you inherit it from? Did they start taking the distributions? Now, these are the rules you need to follow. It's critical that if the required minimum distributions should be taken, that they are taken. And this is for retirees, people like you that need to take these required minimum distributions each year. If it's not taken, there is actually a penalty, but there is a way around it if there is some kind of an exception to it. But for the inherited IRAs, these distributions need to be made, or the beneficiary will have consequences with tax penalties, which used to be 10%, and I think now they are going up to 25%. So
I have a question about that. So let's say somebody had a Charles Schwab IRA, right? And their children inherited it. So who analyzes and tells the client, it's better if you do it this way or that way for tax purposes? Or is that Charles Schwab, or do they go to their CPA and get that information?
I would generally say it's the financial advisor with assistance with the tax preparer. Usually your financial advisor is the one who's looking at your entire picture. They generally know what your wishes are, cash flow needs, etc. And then they're going to okay, let's bring in the accountant to try to minimize taxes or maximize tax benefit in years that again, maybe you're retired, or maybe you took that year off to take care of your parent, and you're in a low tax year. So let's take advantage of a lower, taking money out of the IRA in a lower tax year.
So I could tell my children, when you inherit this IRA, be sure to get advice both from whichever financial institution has it, and then check with your accountant.
Really, there's a few steps. One, you need to know if the owner of the account took their RMD, their required minimum distribution in that year. You have to take your RMD even in the year of passing. So usually you got to talk with whomever Charles Schwab, if that's who holds it. Did the RMD come out? If not, you do need to take it out. Let's just say somebody passes in 2025. They need to take the RMD for 2025, either the person who had it or the person who inherited it. For the people who inherited it, they don't necessarily need to talk to Charles Schwab. They need to know how much they're going to get. and if they took their RMD this year, but then they're going to want to talk with their financial advisor and their accountant because it's their financial picture that we're taking a look at.
Because what's hard for me is that when children, I mean, you know, I'm just a plain old person. And when children inherit, it's like they're not going to know what to do if I don't tell them ahead of time. And they're not going to understand the what was it?
RMD.
They're not going to understand the acronym,
Yeah.
right? So I need to be able to tell them in one sentence what to do. So do you think if I say, go talk to Charles Schwab and talk to your accountant, that they would get the answers they needed?
I think they'll get some guidance. Actually, it's a great point because it's one of the conversations. These are some of like the superficial things that your accountant necessarily wouldn't tell you, your tax or trust preparer wouldn't tell you, and your financial person won't tell you, is talking to whoever your beneficiaries are or whoever your trustee is and say, here's my accountant's name, here's my financial advisor's name, here's my trust attorney, so they know
Excellent.
to talk to that person.
Excellent.
Because oftentimes when we're planning tax returns, we're not saying, hey, please introduce us to your kids. And saying when you're doing this is please introduce, but it helps them make it easier on them.
Got it. I think that's very good advice.
One thing I wanted to also mention is that often people forget to update the beneficiaries, or they don't even maybe haven't put anybody as a beneficiary. You know, you start your IRA many, many years ago. You're supposed to fill out that form. You can't decide who is going to be your beneficiary, and then it never gets filled out. You want to make sure all of your retirement accounts do have designated beneficiaries
And backups. And backups.
Yes, exactly. Because that account will go through probate. If there is no beneficiary, that will just become part of your estate. And that is the number one thing that I want you to take away too from today.
That's so important.
Your IRA beneficiaries.
That's so important. And where I see that problem happen is you're married and your spouse is your automatic beneficiary when you open it up. Then your spouse passes away and you don't have a backup, right? So you always need to check, and you need to check regularly just to make sure, because sometimes we think about it so much, we think we've done it.
Good.
Sometimes the kids don't know that they are your beneficiaries, right? That's the other thing. So
I've got two questions from the chat real quick. Number one, how does the conversation about IRAs apply to Roth IRAs? And then it's a separate question after that.
For Roth IRAs, I believe they just changed it to make it even more clear, because I think Roth IRAs had different rules than the Roth 401k, but I believe starting in 2026, Roth IRAs, Roth 401ks do not have RMDs. They don't have that required minimum distributions, but they do still have that 10-year rule. It still have to be depleted in the 10 years.
They still need a beneficiary.
Oh, yes.
Roth IRA.
Correct.
Or that would go into probate as well.
Correct. And I would like to say about probate is, and if you don't make this decision, the state makes it for you.
The second question from the chat is, I'm planning on gradually giving my estate to my heirs. What is the max each year I can give to each beneficiary?
is that from the IRA or just in general gifting?
I think we're assuming it's just gifting.
Yeah, it's $19,000 right now.
And I think does it go up to 20 next year? I don't know if we got the news.
Honestly, what it goes up to next year.
It's going to be 19 still or 20.
19,000 a person, right?
Per person.
And if a husband and wife are giving,
Right.
they can
then it's
each give
38.
19,000.
Yeah. And what that's considered is a tax-free gift, right? So one of the tools for estate planning to kind of make your estate smaller is people gift the relatives and friends.
That is for the IRA or for the brokerage account too?
For anything.
90,000 now?
Mm-hmm.
Yeah. And I would point out, there are a few other things if you're doing that type of planning. There's some that do not have that $19,000 limit. If you have any grandchildren or children that are in college, if you make payments directly to the college, and I think also medical, if you make again, you have to make the payments directly to the school, to the hospital, whatever, those do not count. So another good. Mine has a delay. It doesn't count to the 19,000 annual. Yeah. And now you can always give more, but just understand that when you give more, it just triggers a gift tax filing requirement. There's no, generally speaking, any tax payment by the beneficiary or by the giver. There just triggers a tax requirement, and it just goes towards what's called your lifetime exemption.
Two questions, if I may. I don't know if I heard you correctly. Did you say RMDs begin at age 70? I thought they began at 73.
I think it's now at 73, or it's about to happen. And it's going to be going up to 75. Give us a little bit of a break. Keep on making changes to these things.
Yeah, you are right. I did misspoke.
Yeah, I think it's 73 right now. It's going to be going up to 75, I think, in another couple of years.
My other question is, there's different ways of listing property: community property, joint tenants, so-and-so and so-and-so, so-and-so or
Yeah.
so-and-so. Are there not different tax consequences depending on how property is listed? And maybe you have some general rules about that specific question.
I can address it kind of generally. One of the big things is what's related to the basis. If your spouse passes before you, depending on how the property was held, community property or jointly, there is a difference in step up. There is not, which then results in a capital gain, possibly different treatment, but it's not, there are just different ways that it gets very detailed that I can't completely go into, or
I can address from a deed standpoint on a piece of real property. So if you have a deed that's joint tenant, right, with your spouse, and you pass away and your spouse inherits your half, which steps up to full value. And she decides she's going to sell that property right away. So her half doesn't step up to full value. So that exposes it to a capital gain tax. You don't know, depends. It depends on the numbers. If you have a deed in community property with right of survivorship, then when you pass away, your 50% goes to your wife and steps up to full value, and her 50% also steps up to full value. So if she decides to sell the house, then there's not any exposure to capital gain tax.
That's generally preferable, but I'm assuming in every situation there might be reasons to do it the other way.
I couldn't see any reason why a husband-wife wouldn't want to do, but I don't know for sure, community property with right of survivorship because of that advantage. And also, if you move it into a living trust, that also it should be a community property trust, so that would step up to full value also.
Another IRA question. If the children are listed as beneficiaries, is there any penalty for not transferring the wealth to the spouse and go directly to the children?
I'm not aware of one.
No.
Yeah,
No penalty.
not to my
I think
knowledge.
the spouse has to sign a waiver, though, to allow that to happen. You can't just skip spouse.
Yeah, California is considered a community property state. So yes, you would want to make sure if that's what you're interested, is making sure it gets documented properly.
Could the IRA go directly to a child?
Yeah, you could. I think we're just saying it's inherent. Let's just say you form long-term marriage that in theory, half of it, or in theory, already kind of belongs to the spouse. Theory. So if you're going to just not have that person inherently get it, I think there is, like Kerry said, that there's a potential that you have to get a waiver. I think you may have to get it. That's what we're saying. We may
I think
need
so,
one, an
because
IRA.
wages earned, which is what goes into your retirement account, are community property. So you can't just skip your wife or your husband. You have to have them agree to it.
Because both would have their own name on their IRA.
Well, yeah, both names are on there, but it's automatic that the spouse is a beneficiary and first beneficiary unless you have a waiver has been signed. Yeah, you're welcome. Mhm.
You have to take it over 10 years.
If it's inherited.
So can you repeat the question?
Sorry. So her question was, if you have a Roth IRA, do you have to take it over 10 years? If it's inherited.
Yeah, if it's inherited, but how do they find out how much you would get each year?
So with a Roth IRA, there is no RMD. So they are required to take out 0 each year. But within the 10 years, they have to take out all of it. So they can choose to take out 50% in year 1, 20% in year 6, and the rest in year 9. Or they can do it smooth, however they would like to. It just has to be done within 10 years.
They can take all of it right away?
Yes.
Okay, good. Thank you.
Yeah.
Out all of it before the people get the money, or how does that work?
So the question was if we wanted to leave the IRA, the beneficiary would be in Slovakia, where I'm from, or another country. And I don't know what those rules are because it would really be a rule over there too. I haven't had it.
A little bit, there is an agreement, a tax agreement between Germany and the United States. Idea what it is because that's all it said. No.
I think for the US, for the US purposes, you know, a US, you have to follow the US, but then I don't know what happens on the other end. I'll have to look it up.
No, but let's say you had
Let's say you had $100,000 or $1 million or whatever, and you want to give that to someone overseas, right?
Before you die
No.
or
No.
after death?
Before I die or after I die, doesn't matter. What are the tax consequences then on that portion of my IRA?
Well, it will be income to them in the foreign country, and they will be taxed.
He wouldn't have
on
to
it.
tell him.
No, you'd have to, it would,
Stuff is kind
There will be a 1099 issued to them.
No, but
Yeah.
the question is, before the money gets shipped out of the United States,
Mhm.
are they going to withhold the money?
yes.
And how?
The financial institution will have to withhold any taxes before the money goes overseas.
So Vanguard would do that.
Oh, yeah.
And there are some sister state countries that have the same kind of taxes that we have. And then there's some where it'll be much higher.
Oh, yeah.
But it'll be handled here before it goes to the beneficiary for obvious reasons. It's too hard to collect over there and so on.
And it may trigger that they may have to file a United States tax return because they just got potentially in the United States income.
Yeah.
Foreign, is really complicated, and the agreements between the United States and different countries, it depends on the type of asset, and it's not all retirement. What we think is a retirement account may be different in a different country. Extremely complicated.
You go to a tax attorney.
Either a tax attorney or a firm that does work primarily with foreign. We do
Yes.
very little foreign. We do not do that type of foreign. It's
Okay. Good to find out though.
Good question.
Mhm.
So one of the things that came up when we were talking was executors and trustees. And I think a lot of people wonder, like, how do you choose that person? And first of all, what's the difference between an executor and a trustee? Are they the same? And how does one go about choosing the right person?
Glad you asked. An executor and a trustee, and if you have a trust, will be the same in both documents. they have different roles. An executor handles things outside the trust, right? And the trustee handles the work inside a trust. The question, though, is how do you choose a trustee or an executor, right? Because I'm finding that many of my clients, as they're aging, they may not have children. So that's an obvious choice, right, for that role. Or they don't want to choose a friend because the friend's as old as they are, right? And so that's not as good a choice as finding somebody younger. So how you choose a trustee, I just happen to have a handout on the back table with anything that you might like. And you can always send that handout to one of your friends if you want them as a trustee. But you're looking for somebody that's organized, honest, obviously, and willing to do the job. A well-organized estate plan is not difficult to administer once you get going, right? So when I mean once you get going means where do I start, right? In my firm, we have an include a document that tells the trustee how to get started, and I think many other firms do that as well.
I was just going to add, we actually do we do fiduciary work as well. As a CPA, we are licensed to be doing that. So oftentimes you can reach out to your investment advisor, your accountant, again, somebody who's maybe a trusted professional, again, a friend, very much what Kerry said. If you generally like to have somebody you know who will be there when you pass, it can be, oftentimes it is a child or a younger sibling, if that's the case. But there's oftentimes, maybe a banker, if you work with a bank.
Let me ask, when would somebody want to pick a professional, like a CPA firm as a fiduciary, or maybe a professional fiduciary?
Yeah. Oh, yeah. And excuse me, I forgot that too. But there's professional fiduciaries out there too, who that is their profession, is that. I would say generally when they don't have any children, and really any kind of a family in the area, or if their family is back in a different country, a faraway state where just administratively it's going to be difficult. And if you have beneficiaries who do not agree with each other, is how I will say it.
Yeah. What if you have a small estate, meaning you bought a home in Marin a long time ago and you've got a couple of retirement accounts? Is there a dollar amount that would be, where a fiduciary might say, no, I really can't afford to take this?
I don't know if they have thresholds. For us, we do it with our clients. It's a benefit of being a client of ours and working relationship. And we don't have a threshold for it.
And then does it cost more, obviously, to have a professional fiduciary?
Yeah, I would think so.
Professional CPA.
Yeah, definitely. Besides that, or because if you have one child and that person is the beneficiary, they're usually going to waive their trustee fees. Whereas a professional fiduciary, I would think your investment advisor, I can speak for our firm, we do charge our hourly rate for our services for that. But it can give people some peace of mind, especially if you try. It's a big responsibility.
Question? Yeah. I wanted to ask a question from the trustees' question processing. The questions come from personal experience. My brother passed away in March. He had 5 daughters. He is in his trust. He listed one that was the least involved in the family dynamics. So she's the trustee. The question is, in the trust, so what's happened is she's decided to take her time in not only getting rid of the assets, but establishing, the house to be sold, which is be quite a bit of money. And she says, well, I'm taking my time. The other 4 don't agree that they can wait a year and a half for being able to inherit what's due them. So is there a way in the trust that you can list a timetable that says, yes, the trustee, she says, I have total authority to do what I want. Well, I don't know if I agree with, is that true? And is there a way to counteract that in wording in the trust?
I wouldn't put any wording like that in a trust for the very reason that you don't know what might be coming up that's causing a delay. I'm not saying in your case, but in my client's case, you don't know. And my solution for your family is that I would just go to an attorney. I would get an attorney consultant and quickly write a letter to the trustee and say, it's time to administer this.
Well, they're talking about that, but they're concerned this is not going to be inexpensive.
It's not expensive. The attorney, you mean?
Yeah.
No. So what you want to do is get an attorney consultant. And the way you can do that is where do they live basically? What county?
Well, the house is in Santa Clara County, but the daughters live in different counties.
Well, just pick one of them. She can call the bar association's referral. And they will give her a half an hour consultation, and they'll write the letter for her. And it's only going to be an hour. It won't cost more than an hour or two to get that done.
Okay.
It's kind of like a demand saying,
Right.
hey, you need to, and then they'll have to, they're kind of provide justification. Maybe they're doing major renovation, or there's other facts. If it's in San Francisco and it has a tenant, there's rules as to when you can kick a tenant out in San Francisco.
Right.
So sometimes there's things that really do drag something on.
Right.
It sounds like that's a good case to have a professional fiduciary who's outside of the family, who will not take their time and just like move things along and not cause the drama.
Yeah. Right. There is a drama. Almost always.
I'm wondering how one goes about finding a professional fiduciary.
Well, I can help you with that a little bit. I mean, there's so many ways. For instance, Katz and Mirka's firm are fiduciaries. So you can also go to, there's a California Association of registered fiduciaries. They're registered and bonded. And you can go to their website and look up different fiduciaries and call them up and interview them. So that's another way to do it. You can ask a friend if they've, maybe they're
That, or your financial advisor,
your financial
or your state, whomever's drafting your state documents.
Mhm.
Oftentimes have referrals of people they've worked with, people they trust, that they can give to you.
And do you have any idea in general what professional fiduciaries charge for their work?
It's all over the board. It depends on how much experience they've had. The more experience they've had, the more they're going to charge. Or there's a fee that's associated, like with you guys.
We charge by the hour just because it's the
I
work
think
is
all
so major.
fiduciaries charge by the hour. So, yeah.
I have two more questions. Number one, how likely is an IRS audit of an estate?
You want to take that?
Well, it depends which. So there is an estate tax return, which is a Form 706. That estate tax return is a tax return that is over the exemption. And so right now, for example, there is a lot of people that would not be subject to filing the estate tax return because the exemption is $14 million per person. So a couple gets $28 million before they have to file a Form 706, which is the estate tax return. And that one typically gets always audited. Now, if the auditor does contact you or not depends, but those get looked at by a person on the desk. What it is, the estate tax return is if you are over the threshold, it's a list of all of your assets, right? It's kind of like a picture of what you died with asset-wise, not income-wise. Then there is another term, which is decedent's estate, which is a tax return that gets filed after a person passes away. So when a person passes away, there's two tax returns that's going to happen unless they die exactly on December 31st. There's going to be their individual return that starts January 1st through the date of death. And then there is a return that's called decedent's estate, or sometimes the trustees or fiduciaries do refer to it as an estate tax return, but it's really a trust tax return, which shows the picture of the income that your assets are generating after you pass away before it gets all distributed to your beneficiaries. Those don't get audited that much, or I haven't seen them. That's kind of was like one of the jokes in the class of the trust class at the program, that those don't get audited as much, but they are important for the income piece, because that's basically all the income that is being generated after the deceased and before it gets distributed to the beneficiaries. And the threshold for filing that return is pretty low. If the estate generates anything about $600, you have to file this return.
Anyone get a copy of those returns, like the Form 706?
They're available online.
Oh, copy of the form? Oh,
You can
well,
just look it up online.
it's
You can
online,
download it.
but usually you don't need to file 706 unless you have this taxable estate or another estate planning tool.
That's actually a good thing to bring up. Yeah.
Yes. You want to take?
No, you take it.
Oh, okay. So another estate planning tool for filing the Form 706 is what's called a portability of the exemption. So each individual gets, let's round it up, $14 million. One spouse passes away. So you can actually file the Form 706 listing all the assets and then use whatever is left of their exemption and pour it over or give it to your spouse. So instead of having $14 million, you can get another 6 million or 10 if your spouse didn't use up theirs. And that's where people have been using filing of 706 for this portability, or it's referred to as
Disui. Mhm.
which I actually don't know what the acronym
It's
is. What
like
is a decedent's?
Decedent's like, I can't remember.
So what is the deadline on that? If my spouse dies and I want to collect, he doesn't spend any of that
Right.
14 million.
You know, I think you
So
have
is
to
there's a
5
deadline of
years
some
now.
kind?
It's
Huh?
5 years.
It's 5 years. So some people just learn about it and we can do the return for this portability. Because one thing with for tax purposes and the estate tax planning is that right now we have this huge exemption, right? $14 million each. So a couple has $28 million before they need to worry about estate taxes. However, there's always that, what if that exemption comes down? It used to be only $5 million back in 2008, I think.
Yeah.
So at that time, right, all the Marin County houses, what their value is, you would have a taxable estate very easily. So as long as we have this high exemption, it's a little bit of a nice thing to have and to utilize also the spouses if necessary.
And one of the ways people talk about estate tax is it's death tax, right? How much is that person that died, their estate going to be taxed? And there's an exemption amount of right now of $14 million or 28 per person per couple. So some of us will never hit that, you know, and even with our healthy houses and the value they've gotten, that's a pretty healthy exemption.
What I like to say, I know this is one of the more complicated estate planning items to understand, is if you have an estate between 5 and 15, 20 million, and one person passes away, this is a really important conversation to be having with your tax accountant. Because when Biden was in the administration, there was talk about bringing that exemption down to 3 million. There was pushback. I just don't think it's going to go below 5. I just would be shocked. But that just means that, but it could always change. So if somebody passes away while it's at the 14, you can basically lock in some of this exemption amount. So yes, we don't look like it's 14, but it might be something that's really important when somebody has an estate If you're a little bit younger and someone passed away and it's 3 million, you might want to lock it in. But if you're somebody who's a little bit older, and you have an estate for 5, 6, 7, 10 million, really think about it.
I have one more question. How long does a trust typically go on after death? Get a death?
Well, okay, for tax purposes, the decedent's estate that I mentioned, it should be completed within 2 years, but it can go on until it is all resolved. So
If it's in probate.
if there is probate, right? Or we've had clients that it's been going on for 6, 7 years. So,
Well, and for me, that question is, when can the trust be closed, right? So the trust can be closed after all debts, taxes have been paid, and after all the distribution has happened to the beneficiaries, and there's nothing left in the trust. Now you can close it. And how long does that take? It depends on circumstances, and it also depends on your trustee and how fast they get it done.
Please note, if you make like an irrevocable trust, some trusts go for years. And that's actually there we have a little bit of a question, but I just want to make sure, just since we're kind of in it. With this exemption amount being as high as it is, if you have not updated your trust or your estate plan in the last, really, I honestly think people should always look at it every 5 years, because I can't remember what I wanted, and things change. Whether how you want to, again, what you want with your body, again, beneficiaries. But if you have a trust that's definitely 15, 20, 30 years old, it could be really outdated with estate and tax planning. We have several trusts that we do where somebody has passed away, and the trust documents just dated that they have what's called like a bypass trust. And it's not necessary anymore. I want to throw out there is the facts have to be exactly right on this. But if you happen to be somebody who has a bypass trust, or maybe your spouse passed away 20, 30 years ago, and you have a bypass or trust A or trust B, you may want to talk to your attorney because this exemption amount is so high. When that trust was created, the exemption amount was $1 million. So it got created. Well, now the exemption amount is so high. If we can get approval from all the beneficiaries in the court, you can actually dissolve that trust, have it become part of your estate again. But now it'll get all that step up in basis. So I wanted to throw that one out because that one's, and we've kind of him and hawed. But now that we know the new rule with at least the current permanent exemption amount.
Yeah, and I'm also seeing a lot of attorneys retire. Right. And people have trusts created by an attorney, and they go, well, what do I do now that I can't even find my attorney?
Yeah.
So you can take your trust document to any estate planner, and they will, and an estate planner doesn't have to be an attorney, by the way, but you can go to any estate planner, and they can take that document, and they can help you amend it if that's what you want to do.
If an heir has special needs and has their own special needs trust, and one's looking for a fiduciary to manage not just the inheritance, but the whole, which I guess goes into the special needs trust and how that gets distributed. Are there some fiduciaries that specialize in what I'll just call challenging personalities, or do you assume whenever inheritance is involved, all personalities are going to become challenging? And the second part of that is, if the heir is in a different state, do most fiduciaries, are they typically only licensed in one state, or often licensed in multiple states?
Well, they can be licensed in multiple states, but typically you'd find a fiduciary in the state where the trust was, or where the special needs trust was signed, right? And the special needs trust can have a different trustee, or it could be a fiduciary or a person, than the actual trust itself that's naming this special needs trust as a beneficiary. But if you want, yeah, if there's difficult, I'm sure there are fiduciaries that specialize in that. I don't know any because I'm experience based and I haven't run across that. But if they are difficult, you definitely would want a fiduciary over instead of a person, like a family member, right? Mm-hmm.
She has a question. Oh, right behind you, the gentleman in the back.
Yeah, the person up front had a Vanguard account. Couldn't Vanguard be the fiduciary?
Yeah. Generally, and you can correct me if you know differently, lots of banks do act as, will act as the fiduciary or the trustee. They usually, you kind of want to, that's a good one that you're going to want to talk to them before, because they usually have quite high or exceptions as to what some that they do not do.
You have to have an estate that's big enough to warrant them taking on the job.
That too. So there's sometimes a dollar threshold to that. It is important. I'd be curious what your take is, because I have two takes and they're completely polar opposite when it comes to trust.
Yeah.
Is how much information you want to give ahead of time. I appreciate it's very personal. It's very private information you're giving, and you want to feel comfortable giving it. And you don't necessarily want to give something too soon, but you do want to make sure you are open so someone's not surprised by it. And a few things that I've come across that I really want to share with people, again, things on the peripheral, is as you might notice your decline, is it might be a really good idea to, again, let that trustee, doesn't need to completely flip the switch and have the trustee do everything. But one, tell the trustee maybe they're the trustee so that they're okay with being the trustee. Maybe having them get bank accounts, your quarterly bank accounts or your monthly bank accounts. This is only if you feel comfortable. The reason I'm bringing this up is AI is becoming so sophisticated. It is going to be becoming so hard. We've had, I think, even our own firm, someone totally got caught, like just in a thing. And when you're living by yourself, it's a little harder to tell. You also may wish to share your password to your cell phone. You might want to share your password to your computer. Again, that's very private. That is the key to everything. If you are married, maybe share it with your spouse. I had a client pass away this year, husband and wife. Husband passed away. Spouse did not know the bank account, didn't have any information on the bank accounts, didn't know the cell phone password, didn't know the computer password. They figure it out, but it's just a little bit easier in the administration.
One of the things you can do is put those passwords in your estate plan binder, which nobody has right to have. You'll have possession of it. And then, if you become incapacitated, someone will be looking for that binder.
Yeah.
Right. And it's just just try not to put it in a safety deposit box. Okay.
There you go. Like
I have a 2-point question. First of all, I wasn't clear that if you say did your trust now, and you've got that 14 million allowance, and you die 10 years from now, and it's now at 5,000, do you get to exempt the 14,000, or it's at the time of? Okay.
Let me so just, yeah, it's at the time. It's the exemption is based off the exemption amount at the time of your death.
Okay.
And that's the one with that portability is, hey, at the time of somebody's death, if you had 10 million each, your guys are kind of okay, but you want to port over because when the second spouse passes away, if it goes down, we can bank something today if somebody passes away.
And the second question is, have we covered? I want to know if we're covering all of the topics, because I'm going to have to leave in a half an hour.
Oh.
I mean, because you got some feedback.
I think we're going to cut. Oh, are we going to cover more topics?
Well, you have some.
No, yeah, I mean, we've covered almost everything, but so if we have more questions, we'll be able to do that as well. One of the things, so I thought we would do a kind of a little bit of a kind of quick wrap up of some ideas we've talked about. So when there's the will and the trust, right? is there a limit to how much of somebody's estate before it goes to probate? And also assume everyone needs both the will and the trust. And one one does certain things and the trust does other different things. Is that correct?
So what you're asking, I think, is when do you need a trust? So you need a trust if recently this year, the exemption amount, that means all of your money added up together, including real estate, it can't exceed 100. It used to be 184,500. Now it's changed to 208,850. You have real estate, you're going to need a trust because your real estate in Marina is going to be worth more than 208,800.
Does that include the IRAs?
It does not include the IRAs or anything that goes by beneficiary.
Okay. So, but if you don't have that beneficiary form filled out, that's where, yeah.
So the interesting thing is if you die before April 1st, 2025, like there's people that have recently that passed away last year, then that exemption amount is lower. It's 184,500. But if you died on April 1st or after, now your exemption amount has gone up. So if you have a small estate, that means you have a car, you have some bank accounts, you don't have any real property. Do you need anything? And the answer is yes. You need a will because you want to name who gets your stuff. You need an executor to handle things. And you really need a financial power of attorney because if you become incapacitated, someone has to handle your finances. And you need a healthcare directive so that if you don't have capacity, then you don't lose your voice. And I just want to tell you something really interesting about healthcare directives. A lot of people don't know that California is called a consent state when it comes to giving organs, right? If you don't want to give organs, you need to put it in writing because we're all consenting to giving organs. Now, the exception to that is I think a family member could intervene, but a lot of people I didn't know that for years. So I just thought that was very interesting.
Kerry, is that different than the sticker on the driver's license?
Well, the sticker on the driver's license, that's interesting because it says, yes, you want to give organs, right? So that's fine. What if you had what if you changed your mind and you put in the healthcare directive, I don't want to give organs? The newest date on that would be the one that would.
I do want to just add is that the post form is separate and different than your advanced healthcare directive. And it is very important to update both and make sure that post form is somewhere.
What is that post?
I don't know the acronym where it stands, but it is the, not going to say this exactly right because it's not, again, I know enough to be dangerous, everybody. It's a much more detailed direction to doctors or hospitals, ambulance as to what you want done. It'd be about whether resuscitation or not. Do you want pain relief? There's several questions.
I think the most important part of that is you don't want to be resuscitated. And so you would put that on your refrigerator so the ambulance people could see it.
Yeah.
Right. I mean,
I think they take that to the hospital too. So again, if you go to, it gives more than just that one. There's definitely a handful of questions, but people might think, oh, I have an advanced healthcare directive that covers it, and it does not.
Where did they get this?
I think you can get it online if you ask any of your primary care physician will have it.
California Medical Association has it.
Yeah.
Pfizer has it.
Yeah, but really important to have that one accessible. We had family experience with that.
In the same area, you talked about you should tell your accountant these sort of secrets or your passwords or things like that. Do you have the same confidentiality as a lawyer would have of what's told to you or what's told to you? that, lawyer would have where you don't have to divulge, or you can't divulge?
That is, I'm gonna just ask it again. I'm gonna repeat your question. Just because the mic's not working. I got it.
If you
Oh.
do you have the same confidentiality rules that lawyers have that can't be divulged or discussed with family members or someone?
Not in that capacity. That is only if we are hired by the attorney for something specifically, then we would have that attorney-client privilege.
And that's the same for my profession. I'm a paralegal registered legal document assistant. And we don't have confidentiality unless we're working with an attorney, but you can be sure that you have confidentiality with me.
So if I tell you things, I'm not sure it wouldn't go somewhere. Say you have scruples.
Correct. I mean, yes. If I have access to I now have your bank. Sorry, her question is, if I tell you things, what can I do? What limitations? In theory, I'm licensed. I could lose my license, doing something like that. And I'm not necessarily saying you should go and share this stuff with it. It is a decision you have to make. But I have noticed. I'm noticing things, and again, as people start to age, and you start, especially if you don't have family who visits you on a regular basis. It's something I instituted this year for clients that we have. We are the successor trustee. I'm actually going to their house at least once a year because people aren't going to necessarily see someone's decline when they're on the phone or if they come to my office. So it's really it's very much a private, personal decision, but it's something I want you to think about.
I've got a couple questions from the chat. The first one is, what constitutes the term incapacity as written in a trust document? Is it doctor as a written word?
It's kind of a gray area, right? Because a physician will write an incapacity letter if they know that you have been diagnosed as being incapacitated. You've got a disease of some kind, or you don't pass certain tests. But there's a gray area where people age and they're fine taking care of themselves. They have a few short-term memory problems, right? But they've found ways to deal with that, and you won't get a physician to give an incapacity letter in that case. So one of the things you can do, if you don't have a trust and you have a financial power of attorney, you can make it effective now as opposed to waiting for incapacity and requiring an attorney. So it's effective now, and it continues effective if you become incapacitated. And if you have a trust, you can do similar thing, but it will only cover assets left outside the trust.
Are you able to, in the trust document, say it has to be done by like two doctors?
It can be two, it can be one, it can be three.
Okay.
I like one because, it's hard enough to get one doctor to do it.
Yeah.
But yes, in the trust, because it's going to financial institutions, they want to see an incapacity letter before they'll let someone take over.
Okay, the second question is, if you receive the gift, are you required to pay taxes on it?
Go ahead.
No. Gifts are not taxable to the recipients.
Unless it's the 19,000, over
19,000.
No, the 19,000 is what is not taxable gift from the giver when you're giving because you're essentially decreasing your estate. And so you can give up to $19,000 without having to file the gift tax return and start using possibly your gift time exclusion.
So let's make it, when you gift somebody, let's just say $100,000, there's no tax by the giver and there's no tax by the receiver. However, because you went past the annual limit, which was 19,000, the giver has to file a gift return to say, hey, I gave somebody $100,000. They'll say, okay, 100,000 minus 19, 81, hopefully my math's right. 81,000 will go against that, your exemption. We talked about that $14 million. That's what the exemption amount is right now, your lifetime exemption. Your lifetime exemption just went down $81,000. So you don't pay anything today. It just goes towards your lifetime exemption. So if you're starting to give millions and millions away, then we'll have another conversation.
And to just follow up and remind you about the gifts if you make the payment directly to college or directly to the medical, there is none of this 19,000 cap. So that one is
You get
more
a
free.
deduction for that?
No.
You don't get a deduction for it.
Correct.
Yeah. It's just
It could be a good deduction for medical, I believe, if they're considered a dependent of yours and that, but just a general good, no.
One more question. If your estate is worth $20 million and you leave half or more to charity, are you still subject to an estate tax?
You are required to file the return, but they will not have an estate tax.
Thank you.
Great.
Under the current limits and laws.
Always under current limits and laws. Several things came up about fiduciaries and about how to talk to your family members, who know passwords or where to find your estate plan and things like that. We have, just for those of you who have not been here before, we have a lot of recordings online, so you can go back and look through. We had a fiduciary here. She talked about what she does and why she does what she does. And then we've had somebody who came and talked about organizing your stuff so that, make sure somebody has a key to your house.
Exactly. It's the key to the house.
Right.
Password,
Your
password for your safe.
Or they know where to find it, or where to find your estate plan, because there's people who've passed away and they can't find the estate plan. And then they start going through the whole probate thing. And then they find out later there was an estate plan. It's just messy. So I know they're difficult things to talk about, but the more you can inform the people in your life what they need to know, when they can ask you questions and when you can tell them things, I think that's one of the things we're discussing here. That's really important.
You brought it up a great point, because you just said these are not easy conversations. I promise you, when you finish having the conversation, you are going to have a weight off of your shoulder. You're going to have so much peace of mind for yourself. Again, whomever's going to be helping you at the end of your life, you are helping them too, but I promise you.
I wanted to tell you a way that you could get your estate plan done for free. It's called freewill.com. And I believe they're a sponsor for Vivillon. And I said, for free, let me check that out. So I went and pretended like I was a client, and I went through their database, and it was very easy to get through. They just ask you some questions, and then they email the documents to you, and you print them out and you can get them signed, and it's totally free. So that it's for a will. I think you can do a trust too. But you need to be careful with the trust, because you got to make sure it's funded correctly. Trust can be very complicated. But if you have
a directive, advanced healthcare directive,
I don't. Oh yeah, because each state has a different healthcare directive.
Yeah, that's interesting.
So I don't know, but here's another little tip: is Kaiser Permanente. Whether you're a member or not, you can go online and get their healthcare directive. It's a PDF that you can download into your computer. You can print it out and fill it out with pen, or you can type into it and print it. And you need 2 witnesses or a notary. You don't have to have both. So 2 witnesses or a notary when you sign, and that's a completely free way to get your healthcare directive. Mm-hmm.
Just a quick one. I have Kaiser, and they have the healthcare directive, but it's a couple of years old too, and I would probably want to have a new one. So can I go on this computer and have it redone?
Absolutely. Yeah, and you just want to make sure that you send it to Kaiser, next time you go into the doctor or something, so it replaces the one that's in there. Yeah, they're not going to do that for you. You have to do that.
And something came up. I think it's called the DNR, Do Not Resuscitate document. I think you were
the post.
Yeah. I just want to say, so my grandmother passed away a couple of years ago, and she died at home, and she did not have that on her refrigerator.
But she had one.
But she had one tucked away in her estate plan where nobody knew where it was. And she had passed. But when 911 came, guess what? They did everything. They tried to resuscitate her. They have to. She would not have wanted that. She was not going to be able to. She was 91 years old. She was not going to be able to even be revived. She had already was, I mean, she hadn't gone into rigor mortis or whatever yet, but she, she was
Transitioning.
Yeah.
And they brought her back to life.
They did not bring her back to life,
But they
did
tried.
all of this stuff and all the way to the hospital.
Were you there too? 'Cause it can be, it
I
is,
was
it
not,
is
thank goodness,
not,
there. So it's
yeah.
really important to have these documents and have them where they need to be.
visible where.
On that subject, my husband was hospitalized 3 times, and the second time the hospital people created that document, and I had it when I called 911 on it for his last visit. The paramedics asked me about it, and the paramedic took a picture of it, so it was on file with Ross Valley paramedics.
That's good.
It was very easy that way.
Yeah, it's all very easy. You just got to remember to update things. That's what once you start doing it, it's like, where did it go?
Come on, you got one question. There you go.
Do I have to go to an attorney to make changes to my living revocable trust?
No. You need to go through somebody though that's regulated to do that. So a CPA, a paralegal, LDA like myself, but you don't have to go to an attorney necessarily to make changes.
A lot of things you don't have to do. It's just whether it's best practice. What I've come to learn is I do not know everything, and I do not know what I do not know.
So you want to go to, you don't want to just, that's why you want to go to a person that's certified in estate planning or no, that can invalidate the document. And if somebody's address changes.
We don't know. I didn't know that either. Darn.
Sometimes people's addresses change in your documents. Don't cross them out. Just put a little Post-it note next to it. And then if you do amend the document, you don't have to amend it just for the address because someone's going to be asking for ID anyway, and people are always moving around, right? But put a little Post-it note to make it easy for your trustee or your executor.
I have a son that has moved abroad and he is one of my trustees. Is he still going to be eligible to be a trustee living out of the country?
Yes. Well, yes, as long as he's a U.S. citizen.
He is working to become a citizen of the other country.
Dual?
Yeah, United States doesn't recognize a dual citizenship. So if he's a U.S. citizen, he can be a trustee. If he's not, then, then you're looking at some tax problems.
Okay.
Mm-hmm.
And the second question is, I have a 457. Is that considered an IRA? It's a retirement.
No, it's a government one. Is it different? That's
different. Because you don't have education required minimum distributions for that.
I do.
You do?
Yes.
Okay. So you have beneficiaries on that one?
Yes, I do.
As well. Okay. So, but if you inherit.
I don't know what happens to a 457.
Yeah,
I mean, obviously it gets inherited, but I don't actually know the rules if they follow the IRA 401k. You would have to double check on that one. That's our challenge, our homework for tonight.
I would say no. I think it's just the IRA.
Yeah, I wouldn't be surprised.
Yeah.
Just like we said, like there's this rule change because they had everything was like this Roth stuff was with Roth 401 had to do with Roth IRAs, and they realized, oh shoot, we need to make Roth 401ks match. So I wouldn't be surprised if there's different rules for the 457.
Yeah, I don't know. Do you guys want to talk about Prop 19 and any
The question is Prop 19.
how it's kind of disconcerting?
Mm-hmm. I'll get it started, and then the CPAs can kick in if they like.
Yeah.
Well, just because I'm a person that talks in layman's language, So Proposition 19 is an amendment to the California Constitution. It used to be Proposition 13, and that was where we could inherit our parents' low property taxes. They do, sort of. So Prop 19 has amended, and we're talking property taxes here. If you're
It's a complicated.
if when you die and let's just use a child as an example. When you die, you leave your house to a child, and that child within 1 year has to tell the assessor's office, that's going to be my primary residence. If they don't do that within 1 year, and there's forms they have to do for that, then the property bill will be reassessed at full value. Okay. If it's a rental property already and it can't be lived in, that will be reassessed at full value, right? So let's say you left it to 2 children. Okay, so there's an exemption amount, okay? It's basis like what the property tax is currently on. So let's say I bought my house for $270,000, right? And now it's worth $1 million. My exemption amount is $270,000, which is the basis, plus $1 million. So anything over $1,270,000 will be reassessed. So for a lot of us, we went from $270,000 to $2 million, right? So then there would be a reassessment. And the child has to live there this all has to happen within 1 year. So what happens if you give it to 2 children and they're not in the kind of situation where they're going to live together, right? And one of them says, okay, buy me out. You need to buy them out. The child that's going to stay still needs to tell the county, this is my primary residence, and buy out the other person. But they have to buy out within the inheritance. Otherwise, that piece will be, half of it will be reassessed. And so to make things calm in your mind about this, the assessor's office has a really nice man, at least in Marin, that you can call and they'll walk you right through it. They'll tell you everything. So I would just, let your children know. Call the assessor's office right away. Okay. So you guys have anything to add to that?
Was there anything more specific you're asking about Prop 19?
I'm thinking they're going to repeal it, but is there any update on it?
There's grumblings. Yeah, that was really a rotten thing they did because they marketed it during the Sonoma fires and they marketed it for, this is going to go towards the firefighters' funds. Who wouldn't be on board for that? But they didn't know. But one of the good things about Prop 19 is it's now you can exchange your property and keep your low property tax, and you can exchange it in any county. It used to be only some counties. Yeah.
So there is conversation around it. It's not at a level that I would be willing to share, or just there's just no clarity as to what it actually might look like. But I wouldn't be surprised. They may say an exemption for primary residents only, and then maybe keep the step up for rentals. But there's too much changes happening.
Well, since we have a couple of CPAs here, maybe we could talk a little bit too about the one big bullish bill. And I mean, I guess it hasn't passed yet, or part of it has?
It has passed.
Oh, it has passed. So maybe there's some new deductions, things that will help retirees or not, or do you guys want to speak to the bill?
Yeah. Well, for the retirees and people 65 years and older, there is an additional $6,000. What are they calling it? Deduction? Or, yes.
Increase
senior
to your standard deduction.
Yeah. If you don't itemize, meaning you get a standard deduction on your tax return, right? Which is a deduction against your income. or you itemize deductions. The itemized deductions are if you have mortgage interest and charitable donations or medical expenses that are over a certain threshold. So the standard deduction for the 2025 is 15,750 for single people, and for married couples, it's 31,500. That means that unless your mortgage interest or charitable donations are over this amount, you get this amount to be deducted against your income that you are generating. Well, for 2025, if you are 65 and over, you're going to get additional $6,000 on top of this standard deduction. So if you are married, it's extra $12,000, which will make your standard deduction 43,500. That's a pretty good number. So 65 and over, you get it automatically. You don't have to check any box or anything. It will be set up there. So that is one of the nice things the beautiful bill added. But like everything with taxes, there is a phase out to it. So, which means as soon as your income goes over a certain level, for married filing joint, I think it's $190,000. This additional $6,000 disappears. But if your income is below the threshold, it's a little extra. So that is one of the things that was specifically done for people 65 plus.
There's lots of nuggets we can talk about. This bill has lots of nuances, lots of random items. If you were thinking about buying an EV, I hope you bought it. That credit expired at the end of September. I think solar, you got until the end of the year before the solar credit expires. One specifically when it comes to people who have RMD, that required minimum distribution, you're allowed to give to charities. It's a qualified charitable donation. It has to come directly from your IRA to the charity. And when you do that, it counts towards your RMD, but that then doesn't become taxable income. So depending on where your income thresholds are, especially we've got a lot of different moving parts, you may wish to actually give more to charity that way, especially because that standard deduction is going to be so high.
Is that effective this year or next year?
The RM, which one?
Well, the $6,000 is 2025 taxes, right? What Kat is talking about, this qualified charitable deduction from your IRA, that has been in place in the past too, but it's especially a great tool right now because the charitable deductions are going to have a limit. Actually, there's two things about the charitable deductions. The easy one, well, easy if you fit within the threshold, is that even if you don't itemize, you do get $1,000 of charitable donation as above the line deduction, which is a real good, welcome piece of legislation.
So I was just gonna say, so previously your charitable donations would be part of your itemized deductions. Now, if you take the standard, you get a little benefit. So it's nice that way.
Yeah, because those charitable donations you might have done that were $500, $600, it usually didn't make a difference unless you were itemizing. Now it will be counted. So make sure to save your receipts.
I do want to say it's going to be very confusing. Some things in this bill, in this act, are effective 2025. Some are 2026. There's some things are even a couple more years or just for a couple years now. So it is not a one thing fits all. It's not, there's the threshold for different things for the standard deduction or the extra bonus or your state and local taxes. California, you paid your property taxes if you haven't bought your home really recently. That is now up to 40,000. That itemized deduction previously was capped at 10. It's now capped at 40, unless your income's too much, and that's a threshold of $500,000. So there, some of these thresholds are coming into play at different times. It's become quite more complicated.
Fun one to mention, which you might want to share with your children if they are helping you with your care, is they started this senior caregiver tax credit. It's up to $5,000, and that's for the family members if they are helping you and spending money on some, medical equipment or medical care. They can actually get a credit for it on their return. So that is a pretty nice new thing. Has to be for qualifying seniors 65 and over, and you do need to have the help.
Does it have to have that separate account? Is that the one that has to have the separate account?
No, the one that you are thinking about, the separate account, is actually kind of like an IRA, which actually, this is not for the seniors. This is for the family members where they can put money into this caregiver savings account up to $3,000, which is going to be deductible on their return, like an adjustment to income. And then they will be able to use the money in that account to pay for medical expenses. So these are all new, even to me, to us.
Yeah, these are all new.
But there is a lot of different provisions in this bill for seniors and for family members to be getting some benefit, of course, within the income thresholds. Another one was for children, parents usually get a child tax credit. And now there is going to be a senior, they are calling it dependent care credit for seniors. And so if you are a dependent, you can be claimed as a dependent on your family member's return. The expenses related to your care can qualify towards this credit. So it's really important to kind of know or work with somebody or see if there is any benefits that you can get from this bill, which brings on so many different facets and taxes.
That $1,000 deduction you were talking about, does that have a term or a definition that tells?
It's just charitable deduction. It's part of telling your accountant or whoever prepares that you made this donation, cash charity. Before it would fall on that itemized deduction list. Now, as long as it's cash, right? Yeah, I don't think
it has to be cash.
Goodwill is not, giving to Goodwill closing and such is not going to qualify, but cash donations will.
I'll add that at Vivalon, we get a lot of IRA distribution.
Oh yeah, the IRA qualified.
The QCD distributions, we get quite a few of those so that people aren't, they want to reduce their tax burden.
Yeah.
And we also accept donations that will qualify for that $1,000 threshold. Just saying.
You got to put it. Yeah. And that's to finish that is that again, with that higher standard deduction, I don't think we add is they now are adding a floor. So if you do this itemized deductions, let's just say you make $1 million. We all making $1 million. The first 0.5% of your charitable donations is no longer deductible. Where you used to never have a floor. So just like medical, you had to pay the first 7.5% before you got any benefit. You now have to pay the first 0.5. So it does make, especially if you are itemizing, you may, and depending on how much you give, it does make it much more advantageous to especially if you give significantly from that IRA directly to charities.
That 0.5 does not count if it comes from your IRA.
Correct. Yeah.
Correct. That's the nice thing. Yeah.
So do we have any more questions on the floor or from Zoom? Do you guys like this format? Yeah, it was nice, huh? It felt like more conversational, and I think we got a lot more questions.
I learned something.
Me too.
Yeah,
me too.
I have one more question from Zoom, which is, can Kaiser's healthcare directive be used outside of California? Does each state have their own healthcare directive?
I'm going to say that if that's all you had, that it would be recognized. But each state has their own version of healthcare directives. Some of them even call it a living will. And so you can go to that state's medical association and you can get whatever that state's form is.
Great. Well, thank you. Thank you all so much. Thank you. Can we have a big hand for our presenters here today?
Thank you, guys.
That's really wonderful. As I mentioned, you will get an email with the recording of this presentation along with everyone's contact information so that you can follow up with them, as well as a link to, I do have a link on there for healthcare directive, for free will, and for our previous recordings if you want to see something that you maybe missed in the past.
Do you want a PDF of the how to choose a trustee?
Oh, I'll add that. Yes. Thanks. Kerry will give me a PDF of the how to choose your trustee. So I'll put that in the link as well. There'll be a lot of stuff in there. So, you know, we want to give you as many resources as we can. If you could, if you wouldn't mind filling out the estate planning workshop, you can just leave it on the back table, our feedback form. You'll also, for folks on Zoom, you'll get a link to fill it out online. And if you don't want to fill it out now, you can fill it out online later. Our next workshop in November is navigating your changing care needs and exploring the healthcare directive. So how about that? And that's going to be November 19th, right here, same bat channel. There's a flyer in the back with a QR code. You can register or just type in the link and sign up to register for that one. And there will be no workshop in December, but then we'll be back in January, going full steam ahead. So thank you all so much. And I'm sure these wonderful women will stick around for a few minutes if you have a question you want to ask. Thank you, everybody.